Good morning, ladies and gentlemen. Well, last week we had the first significant move in the risk dial towards zero and towards risk off. So I think it would pay to spend a couple of minutes going through some risk charts and see what the market is actually currently worried about. It's obviously worried that a growth scare is coming. Now, whether it's going to be a scare or the proper thing, we shall find out. But what does the market do when it fears a growth scare ahead? And we'll examine the reasons as well. And that is, it goes to, 5% off the highs. Last week we tried the highs, we just couldn't do it, and we sold off quite heavily into Friday. And that is probably a pattern which is going to continue in the short term, and let's examine the reasons. All these risk charts look much the same, and ITOT over government is the broadest one, and really it's the one that tells you the whole story. Why would ITOT over government need to consolidate? Well, if you fear that tariffs are going to reduce world trade, which is anti-growth, if you fear that Mexico and Canada are going to be tariffed and there's going to be less trade, less growth, if you fear that the Besant Treasury is going to concentrate on the yield of the 10-year note and not so much on Fed funds, you get a situation whereby the market is afraid that the targets for GDP are not going to be met, and that in the second quarter you will probably have a GDP in the ones as opposed to the high twos. That process is underway. What does the market do when that process is underway? Well, it goes back to the 200-day moving averages of these risk parameters. So it goes down towards the 560 area. I think there is very scant proof that we are in a growth scare. You don't need proof for a scare. What you need proof for is that it's happened. Now, we might fear that it's going to happen, and I think that that is more likely than not to happen over the course of the next few weeks. We have a traditionally weak period for equities starting in the second half of February, which lasts about a couple of months. And that is probably what we are witnessing at the moment. I would not be surprised at all if all these charts of equities over bonds over the time came back towards the 200-day moving average, and then we see. By then we will have proof whether growth is slowing or not. And that will really matter for the shape of the yield curve, and that will really matter for things going forward. But I think over the course of the next couple of weeks, it's more likely than not that we cannot sustain any new highs in equities, and that we need to basically retrace and be ready around the 560 area in ITOT over government. That basically negates everything that's happened since the election. This is a very, very important line. This is where we were before the election. The market is basically saying that it doubts that the new administration can really push growth any faster than the previous administration. And it would make sense that we trade around these levels for a while, and then we see. The problem that the bond market is facing is that while we still have absolutely no data confirming that there is a bond scare, we have plenty of data which shows that inflation is not falling. In fact, we have some quite reliable data that shows that inflation is pretty stubborn and might even be rising. And therefore, we could be having stagflation. So what is the market doing? As you can see on Friday, basically the whole curve came off 7 basis points. We're having parallel shifts in the yield curve. And why would that happen? Well, the 2-year note is well below general collateral now, which is around the 435 area. And every time it gets to general collateral, there are buyers. So 442 probably isn't going to happen anytime soon. And this trend of slowly chipping away and coming down towards 406 makes some sense, because it does make sense that if growth starts fading, eventually that will make inflation go down. And if inflation goes down, then the Fed will be able to cut. So it makes sense that you increase slightly the odds of a cut and you bring them even forward. So that is why you are getting these very small market moves, and I think that will continue. I don't think that you can take twos below 4% and say we're definitely going to get cuts very soon, because the data just doesn't support it. What it does support is increasing the odds that we will have these cuts. What is the market basically saying? It's saying that if you fire 250,000 government employees, you are bound to increase supply of labor in the market, and therefore you are bound to decrease the increase of wages, and that is deflationary, and that should calm the current bout of inflation. You decrease demand, you go from jobs which are well-paying to jobs which are less well-paying, and therefore hopefully inflation is going to be licked. I don't think it's that simple, but what does make sense is that for the time being, the market keeps on increasing the odds of cuts and brings them forward. So the 2-year, I don't think it can go below 410. The 5-year probably can get to around the 413 area. And the 10-year, which Besson says is his benchmark, can probably come down to 428 over a bit of time, and then we see. These are very, very small moves which actually don't change anything. And it makes perfect sense that if there is a bout of risk off, that people fear that growth is going to be a lot slower than the market was pricing in just a couple of weeks ago, then people buy bonds for the safety of them, and they sell equities. And there are some fairly big flows for that to happen. I just think that the moves are going to be very, very small. You're not going to get a move, I don't think, all the way down to 370. I think that is pie in the sky. A growth scare can get us to 428, but it's not going to get us much lower than that. It's only if that data gets confirmed that you will get a rush into bonds. We are a million miles away, at least 4 weeks away, from getting some really strong data which shows A, that inflation is moderating, which is more important for the long end, and B, that there really is a growth scare. So I think that any kind of move in risk assets is going to be less of a move in bonds and more of a move in equities. And that is confirmed by the fact that 2s10s really did absolutely nothing last week. What did they close? A basis point different. And we are exactly where we were back in October, and we are exactly where we were at the beginning of November. The yield curve is not moving. And that tells me that the market is absolutely uncertain as to what can happen here and the speed at which it can happen. Because if people really were convinced that there was a growth scare, they would be buying twos hand over fist, because the Fed would like nothing more than to be able to ease. But the current data is just not going to allow them, and therefore the yield curve just parallel shifts. Where it doesn't parallel shift is with anything with duration. So anything like 530s, it's actually steepening a little bit, and it steepened a little bit last week. This can probably keep on going because the fives have some duration while the twos have very little duration. So people are buying duration, but they are very uncertain still, and the moves are really tiny. I'm not worried that this is going to accelerate to the downside anytime soon. The time it will accelerate is when we have A, data which confirms that inflation is moderating, and B, data confirming the fear of a growth slowdown. If that happens, this is going to go to new lows without a doubt. What is the best instrument to play a growth scare? Well, it's probably tips, because if you're afraid that you are going to have lower growth and the inflation rate is still going to remain fairly sticky, why not get 2% over it, right? So this is going to be a better yield than anything that the nominals are offering. And that is more or less what this chart is saying. This chart has turned the corner. I think that at some stage we will try, and this is unadjusted, okay? So if I press this and I get the adjustment, you can see that it's a completely different chart. But let's have a look at it unadjusted. I think that we will trade up here at 110 at some stage, simply because it's the best thing to hold, this and gold. And we'll see later on that gold is actually outperforming tips by a mile. But tips seems to be the logical place that you hide in if you are afraid of a growth scare. You are out of equities, you're into fixed income, but you get 2% more than the inflation rate. And if you fear that the inflation rate is sticky, this is much better than nominal yields, at least to me, unless you think nominal yields are going to go a hell of a long way and the Fed is going to cut a hell of a long way. I just don't see that. I don't see inflation being able to come down very much at all. I think it's going to remain the 2.5% to 3% range, and that the Fed can do what it can do, in which case tip is probably the best place to hide. I think that everything I've said so far applies to Germany just as much as it applies to the US. I think the odds of higher rates in Germany are almost zero, so every time that the Schatz goes a bit higher, I tend to trade it from the long side. What are the odds of a growth pickup in Germany or Europe in general if there is a growth slowdown in the US? I think they are fairly negligible. I know that the ECB would probably like to stop cutting rates around the 2% area. That makes perfect sense because inflation isn't really licked there either, but it's certainly a lot lower. And the impact of tariffs, especially if Trump goes berserk and uses VAT as a tariff, or defines it as a tariff, which of course it isn't, but he can do anything he likes, that will really be a deflationary tsunami in Germany, because if an exporting country gets 20% tariffs put on their products, it's not good. Therefore, I still think that it's far safer to play it from the long side in Germany than it is in the US. You have much lower inflation. You have a central bank which can cut. You don't have a deficit which is nearly as bad. And therefore, it makes sense to me that you can play that from the long side much more easily than you can play the US. But can he go that far? I think that we are going to remain in this range in bobble, bunds, and it's quite obvious that this 257 to 252 area is very, very difficult to break. And being long through options from these levels must make sense. It just has to make sense, because if not, you are looking for much higher rates, aren't you? You're looking for returns up to 290, and that in this scenario makes absolutely no sense. I think the bunds belong in this range between 257 and down to 225 in extreme kind of risk off. That is the range that we should be trading in for the time being. If you look at the differentials between the US and Germany, you can see that the 2-year notes differentials are still slowly turning upwards. And I think that we will be in this range, something like 201 to 230, 25 basis points range, basically. And every time it comes here, you just have to start trading the shats from the long side. It just makes perfect sense. Tens is the one that is actually beginning to be not worrying, but actually is telling you that people are buying more US because of the yield pickup, and they fear that the growth slowdown is going to be more evident in the US now than it is in Germany. I tend to disagree. I think that this spread is not going to go a million miles, but I think it's going to be very well supported around this 191 area. And I think I would prefer to be long of bunds at 191 than 10-year notes. As you can see, all these charts are basically reverting to where things were at the beginning of November, when the US election took place. Whichever chart you look at and go back, all we are doing is retesting where we were at the beginning of November. The Dixie last week did exactly what I thought it would do. It got to the 0.382 retracement of this whole move up and bounced slightly. Very unconvincing bounce, I think, few days sideways, and then it too can go to where it was at the beginning of November, which is exactly here at the 50% retracement, which is 105.17. That's the 50% retracement, and that is exactly where it was at the election time. Basically, we are retesting in everything the election day. And that makes some macro sense, doesn't it? It makes sense insofar as we don't know whether these new policies are just going to bring about a growth scare and do nothing for inflation, in which case why should we be higher in anything? And that is probably exactly what the market is saying at the moment. We don't know. Let's retest those levels. Let's wait for data, let's see what the data says, and then we can make our mind up. I think that over the course of the next 2 or 3 weeks, we retest 105.17, we don't go through it, and then we're ready for a bounce. But how do we get there? That's the interesting thing. I don't think we get there through a big move in Euro USD upwards. I think Euro USD is what it is. It's a currency, the euro, which has no reason to appreciate, or absolutely, I don't think Trump really cares whether the euro is 105 or 1. I think what he cares about is the yen, and therefore the trend for euro euro JPY has to be down. You can see that every time it rallies, and now the rallies are getting smaller and smaller, it just comes back down in no time whatsoever. I think over the course of the next few weeks, we retest the lower levels of where it was, and that is somewhere around here, 151, 152. That is where we have to go in Euro USD. Stop all these people out. Everyone who's here needs to be stopped out, and then we are probably ready for some bounces in Euro USD. What does that tell me about the yen? I think that tells me that we trade 146, that kind of thing, and then we bounce. All these people who are long from up here need to be stopped, and you can see that this 151.60 level is the really important level. You can basically say this is a period of risk on when we were above 151.60. These are periods of risk off when we were below. And I think retesting at least this 146 area makes perfect sense to me. That's enough for the DXY weakness, and then we can bounce. You can see the 200 moving average is slowly turning, and I think every time we get to 151.60, you're supposed to buy puts on USD JPY, because I think it trades 146 within the next month, and that's probably enough for the time being. This is a weekly chart of gold over TIP, and with adjustments, because it just doesn't make any sense to look at a chart of something which has no yield against something which has yield unless you adjust it for the dividends. And as you can see, we are just a million miles away from any moving average, and this has never really happened before. It's gold outperforming real rates. It's very difficult to say what this implies. Well, it's not difficult to say, it's difficult to believe it. It basically says that we don't believe the US Treasury. Could it be that it's just the Chinese pushing it because of geopolitical considerations? Yes, it could be. But it also tells you that if you're supposed to be hiding in TIP at the moment, you could just as well hide in gold. And that is why it's so difficult to see much of a retracement in gold unless it's part of a gold TIP retracement, i.e. it retraces against TIP rather than against anything else. So let's have a look at what gold is doing on a weekly basis, and you can see that it's way outside the Bollinger Bands, and that never really lasts all that long, but it can certainly last. Since the beginning of the year, we are up, 10-odd%, and it's showing very few signs that it's going to calm down anytime soon. I don't think that we are going to see it much below these central bits of the Bollinger Bands, and certainly I don't think that we're going to see it below 27.90. I don't know how to play it. I prefer to play it via long tips and wait for a retracement in gold, which might not happen at all. But what I'm trying to say is that the macro is saying that there is something really fundamental going on, because that chart of gold over TIP, I really would not expect or have expected this to happen. It is just something which makes very little sense unless you believe that there is a real possibility that CPI is vastly undercounting inflation, and or that the Treasury just won't pay up one day. I don't know what to say about this. I think gold is much more dangerous than TIP at these levels, but I can see why people would prefer gold. I prefer TIP for the time being, but I'm very close to saying that you have to buy some gold as well. It's tough to see a real growth scare which means something, i.e. not just a, oh my God, I'm scared, but really there's a growth problem without GSG going down. And GSG keeps on flirting with this 23 level that I think is so important. And if we switch maybe to a weekly chart, you can see how important it is, because we've basically spent 2 years in this range. If it starts busting through this range, either we have an inflation problem or we have no growth problem, or both. And really it should be going down, and it's not. So I'm quite weary of saying that yes, we're going to get a growth scare, or that we're going to get a growth scare which actually is sensible, unless and until we start taking out the 2025 lows, and that is around 22.35. We start taking those out, then I think we trade all the way down to 21.60, and that does make sense and says yes, there's a growth scare. If, on the other hand, we start trading up through 23 and we get a couple of weekly closes above 23, then either inflation is ripping or something really is wrong. And if we look at gold over GSG, that is making much more sense. It's saying that gold is being preferred to commodities, and that I can understand. That I've been telling you for a long time, that any time you get a retracement in gold GSG, you're supposed to buy it. But unless GSG starts going down and gold starts flagging, I don't know, staying, doing this, then where is the growth scare to come from? I can't see commodity prices going up while there's a growth scare. But I do believe that we're going to get a growth scare. It makes perfect sense to me. The only thing that would deny my belief that we're getting a growth scare is if GSG now starts spiking through 23 and closing, let's say, 2 weekly closes above 23. Then I have to change my mind and say my macro narrative is rubbish. I believe that a stock like JPM can actually tell you a lot about the US economy. I think the last couple of days show you that we are not going to go and power ahead here. We could have some brief retracements to 270 or something like that, but we are probably ready to retest something like 250, giving it a couple of weeks, letting these moving averages catch up. And also Berkshire Hathaway can tell a story too. I don't think this market is ready to bust to new highs. I think it's far more likely to trade around, fill some gaps down to 460. And I think these two financial stocks tell you all there is to know about the state of the US economy, and that it's uncertain. That is what they're telling me. Uncertainty is going to reign over the next few weeks, and that to me means, in aggregate, lower prices. Enlarged, clean chart of the SPX with my levels. As soon as it started breaking this 60.90 and 60.85 area on Friday, I started buying put spreads. And I will continue buying put spreads until it closes back above 60.90. From everything I've told you, I think a scare will develop over the course of the next couple of weeks. And I think that the natural place where it will trade over the course of the next 2 or 3 weeks is 58.64. That is a gap close, and that is what makes sense. I've never experienced in all my years a growth scare which ends 2% from the highs. That is not a scare, right? I mean, who is going to get scared of a 2% move in the indices? No one. It has to be a lot more. It has to be 5, 6, 7%. And this is beginning to be that kind of area. A lot of people will be very scared below 58.65. I think that what makes sense is that we get there, we bounce, we go through, and then we come back to it. That's the kind of environment that I think that we're in. And if we look at a weekly chart, that makes perfect sense, doesn't it? Why should we take out all these weeks of trading, and this is around 58.30? So we go down, bounce, go down, bounce, and basically remain around that 58.60 area. If there is a growth scare, it has to be painful. It can't just be 2%. That makes no sense to me. And if you actually enlarge this chart, it has to make sense that we go down at least through the 200-day moving average and probably through 57.77 and then bounce back to the 200-day moving average. Sorry, this is not the 200-day moving average, this is the 200-period moving average, because the 195-minute chart splits the day into two. That has to be the kind of behavior that you have if you have a growth scare. Now, what tells me that there is a growth scare? The fact that we couldn't maintain the 60-90 level. Below 60-90, the moves should be fairly rapid to the downside. You can see where the Bollinger Bands are, but that doesn't mean very much. I am convinced that we trade 58.65 over the course of the next 1 or 2 weeks. And here we have the Nasdaq, which just could not hold the 22,100 level. It's actually a far more stable chart than the S&Ps. And even here, what makes sense to me is that we return, we gap fill around this 20,700 area, and then go back into the range, having stopped everyone out here, maybe go all the way down to 19,900, and then we go back. These are the only thing that makes sense. These moves that we've had so far, even on Friday, are not going to stop anyone out. If we are really going to say that the market is scared, we need far more than we've had now, and then we need a period of stability whereby we try to turn the 200-day moving average or the 200-period moving average, and that we are just not getting yet. All we're getting is things like this, which, should stop people out, and then we return to the moving average, and then we slowly go up. A growth scare has to be like this, i.e. it has to be quite fast, and it has to go at least 5%. Otherwise, nobody is going to feel it. If we have a look at Europe and also at Japan, I think Europe is exhausted up here. Trading above the weekly Bollingers, trading above the monthly Bollingers. It's time for Europe to retrace as well. And let's say that Europe doesn't retrace very far, but just retraces down to 5,200. That is still, 4%, and that would be great for the S&P to trade down to 58.50s and stop people out. So all these charts have to start looking bearish for an equity bear market in general to take place. For a scare to take place, all you need is 4, 5, 6% retracement here. And what do? We go back to 5,200. We don't give anyone a chance to cover if they were short here, and then we can go back up if there is no effective growth slowdown. But we need the scare first. And if we have a look at the Nikkei, that's looking very, very bad, but that I think is because of the currency more than anything else. I think the likelihood is that within the next 2-3 weeks, we break these 37, 500, 37, 800 levels, and we trade to something like down 35,000, and then we bounce. We need to stop people out. If we have a look at these monthlies, they are pretty ugly. I'd love to see a monthly come down to this 35,000 area, and I think that that will probably be enough for all the equity markets to have stopped some people out and be in a position to then again rally, unless the growth scare really does materialize. But for the time being, I really think that we need lower prices in equities. Trying to summarize the week is basically that it's impossible for everything that this administration wants to take place at the same time. You cannot have 3% growth, and you cannot have 3 million barrels of oil, and you cannot have a 3% deficit. You can't have it all at the same time. What you can have is you can have a lower budget deficit through Doge and through layoffs. That is definitely possible. I don't think it's going to make a hell of a difference, but that is going to cause a slowdown in growth. And while growth has been very good, and that is why the stock market in the US has outperformed every other market in the world by such an extent, I don't think that that is completely sustainable. And at some stage, whether it's next week or the week after or the week after that, we're going to get a growth scare. I'm absolutely convinced of that, and buying 1 month puts in SPX to me makes perfect sense. And I will continue to do it until we start holding levels of new highs. It just doesn't make any sense to me that we won't trade at least 3 or 4% lower than we did on Friday to stop people out, because what's happened so far has stopped absolutely no one out. That is my key central level, 58.64. Only there do I start covering my shorts. Thank you very much indeed, and tweet you tomorrow.